Hi guys, welcome to chapter 7 video. And in chapter 7, we're going to be learning how to do some entries for things that affect the balance sheet. So in this video and for the interaction for this chapter, you're going to be commenting in groups in the forum on one section of what you'll be learning how to do in this chapter. You can see over here on the right, I listed the 6 group topics. This last one is changed to petty cash. So these are all things you'll be learning how to enter in QuickBooks in this chapter. And in this video, we're going to look at how the balance sheet is affected in the journal entries that are made so that when you're doing this in QuickBooks, you understand what QuickBooks is doing in the background and what you're essentially doing with the transactions in QuickBooks. So first, let's just review the balance sheet and the types of accounts that we have on the balance sheet. So the balance sheet is kind of the big picture report for a business and value. And you'll remember we covered this in the Appendix A, going over accounting. So now we'll take a closer look at what's on the balance sheet. So we have assets equals liabilities plus owner's equity. And that, of course, is the accounting equation. And assets is everything we own of value. That includes fixed assets, which are a big part of a business's balance sheet if they own assets. Everything they owe, like loans or anything they're obligated to pay or do. And then owner's equity. And owner's equity is based off of retained earnings and the owner's contributions and withdrawals from the business. So remember, a balance sheet is as of one day because these are permanent accounts, which represent the running total in the business. So they start at 0 and then they have a balance as of any day throughout the business. So a good example of this is your bank balance. Your bank balance only has a balance as of any day in time, right? And all of this stuff has more meaning when we're talking about the value of the business, when we look at the entire picture of the balance sheet versus just knowing how much cash is in the bank account. Someone could have a lot of cash, but if they have a lot of liabilities, then that's less of a good thing than if they have less cash, maybe less liabilities. So obviously it depends on the situation, but it just gives you more information about the total value of the business by looking at the balance sheet. So remember, these are permanent accounts. Your income and expense accounts are income statement accounts, and those are temporary accounts because they tell us about profitability over a period of time. That's why your income statement is for a period of time. The balance sheet is as of one day. This is the value of the business. So those income and expense accounts on the income statement, those are temporary accounts. And your retained earnings, the first period is going to be 0. And after that, it represents the running total of income and expenses for all of the prior periods. That's how those temporary accounts get zeroed out at the start of a new period, because their net income, net loss goes into that retained earnings. So although this says $2,000, if this business has been in business, this is its 3rd year, maybe 1 year it lost $50,000 and the next year it earned $52,000. And so the running total is positive $2,000. Okay. So now we're going to talk about these different transactions that you're going to learn about, and I'm going to go through some of the entries that are in your book. So I'd recommend watching the entire video and then maybe rewatching the section and reading the book for your post in the forum. Okay. So prepaid rent. Prepaid rent is when you're paying rent in advance. So the example in the book is on page 239, and it's paying rent 6 months in advance. So that journal entry is actually like prepaying rent for 6 months. And in that situation, we're going to credit cash, right? Because we spent cash. $700 per month times 6 months, $4,200. But we're only going to debit rent expense for 1 month because we're going to match our expense each month with the income. So we're only going to deduct rent expense each month. We're not going to deduct 6 months of rent when we paid it. They might be prepaying rent because they're going to get a discount or it was part of their agreement, whatever the reason. This is how it's handled because we want to match the expense per month with the income earned that month. And even for cash basis taxpayers, rent is often, because it's a big expense, required to be spread out. So were you debiting the difference of what we're paying for 6 months and our expense for 1 month? The difference is this $3,500. And of course, we need a debit. And a debit is going to be our prepaid rent. And you can have a prepaid account for any type of expense. It's when you don't want to deduct the full expense, but you've already spent the cash. So let's take a look here at the template. Prepaid accounts are under current assets. So we're just moving that money that we spent from the bank balance to the prepaid and taking an expense which goes on our income statement and will get dumped into retained earnings at the end of the semester, at the end of the period. So that's the initial entry to record it. Then each month, and so in QuickBooks, you'll be setting up a prepaid rent account, which is a current asset. And then each month, you'll create a repeating entry that can be handled automatically because we already spent the money, to make it an entry like this: debit rent expense and credit prepaid rent. So you can see we debited the prepaid rent, and then each month we'll credit prepaid rent to take that out of there instead of cash because we already paid it. So you can see how that's handled. Now, one thing to note, if you're at all confused by these journal entries, be sure to be writing down this little cheat sheet I have right here. Debits are left, credits are right, that's all it means. These are your account types: assets, expenses, and draw for capital all have a normal debit balance, which is the left, which means you debit to increase those types of accounts and credit to decrease those types of accounts. On the other side, we have liabilities, revenue, and capital. Capital includes contributions, retained earnings, shareholders buying stock and putting money into the company. If a company issues stock to shareholders, all of those things have a normal credit balance, which means you credit to increase and debit to decrease. That should have said the opposite. So keep this cheat sheet handy if you're getting confused on debits and credits. Okay, our next section is uncollectible receivables. What do we mean by that? We mean accounts receivable. When we send out an invoice, we debit accounts receivable. So when you record an invoice in QuickBooks, this is the journal entry that's happening in the background. Accounts receivable for that customer is automatically being recorded. And on the other end of that is sales revenue being recorded on that income statement. Now, if it's a cash basis customer, you won't necessarily see it. But if it's accrual basis, then you will. because accrual, we don't care about the movement of cash, right? It's only when we record revenue when it's earned and expenses when incurred. So then when the customer pays that invoice, when you go receive payment in QuickBooks, that's recording that we've gotten payment, not necessarily cash, right? Because until we deposit it into the bank account. So that's an extra step that QuickBooks has to mimic real life and where the payment is at. But the basic journal entry is we debit that we got cash and we credit accounts receivable. With QuickBooks, this is undeposited funds, and then undeposited funds cash. So with uncollectible receivables, if we decide, hey, someone's not going to pay us, we've got to get that accounts receivable off our books because it's sitting right here in our current assets, affecting our entire value of our business. So to get it off the books, we will debit bad debt expense and credit the accounts receivable, which removes it, right? Accounts receivable is a current asset. Credit offsets that. Just like we set up here, when they pay, it's debit cash, credit the accounts receivable. Well, to write it off, we're just going to debit bad debt expense instead. And so one of the ways that you'll do that is by using a credit memo, which you've used in the past, but now it's going to be used for the purpose of writing off that invoice amount. And notice that the only reason why someone is able to take bad debt expense is because they already recorded sales revenue. With a cash basis taxpayer, a real cash basis taxpayer, if you haven't recorded the sales revenue, you can't take bad debt expense. But we're basically following accrual. Okay. The third section, third group, and the third entry you'll be making is setting up fixed assets, which you'll do using items and a feature in QuickBooks. And so when we initially buy the asset, it gets put on our books with a debit, credit however it's paid. We'll talk more about that in our next entry. But then the real entry that you're going to be recording with this is how you get to deduct that asset as an expense, because you don't get to deduct the full amount up front, right? Instead, we have a special way of taking expense for fixed assets by allocating that cost over time so that we're deducting the expense related to those assets as those assets earn us money. Now, we have a special account so that we keep these assets on our books at their full value, but we only have the net amount of those assets minus the depreciation expense that we've taken to write them off. Only the net amount goes into our value of our business, but we'll always see the value of those assets so that it's clear that those assets are in the business, regardless of depreciation expense taken. So that's why we have that special way of writing off assets, because they are so important to a business so that the value of them can be seen. So that entry is debit depreciation expense for the asset, credit accumulated depreciation for the asset. I know you can want to credit the building, right, to offset that, but we don't do that. We track it in this separate account so that we can see these important assets. Okay, now the next one that you'll be doing is a loan. There's a specific loan tool in QuickBooks, but people often get confused with loans. So we're going to go over this right here with the journal entries. A lot of times people will pay a business loan or a loan that they use to purchase something and they think that they should be able to write off that amount, right? But you can't write off that amount because you're just paying someone back for money they lent you. So let's say that we bought this building up here for $100,000. We paid $10,000 down in cash, so we credit cash $10,000, and we had a mortgage for $90,000. Well, why is someone going to give a business a mortgage or a loan? Because they're going to be paid interest expense periodically. That interest expense is extra. It's in addition to this amount. So that interest expense is deductible for us as we make payments. Remember, you get to start taking depreciation expense once you record the asset. It doesn't matter if you're still paying a loan on it. You start taking depreciation expense, which you'll be doing in that entry. So once we buy the asset, you're going to set up a liability, a loan or mortgage, and there's a specific feature in QuickBooks called the Loan Manager that handles all of this for you. And this is the entry that will then be handling for you when you make payments. When you make payments, you credit cash how you paid, but you're going to debit interest expense and debit the loan. A loan is a liability, something you owe, normal credit balance. So this credit puts it on the books. And then when we make a payment, whatever portion of that payment is allocable to the loan just offsets the loan itself. The difference, the extra that we pay, is interest expense. An expense is what type of account? It's on the income statement, temporary account. Okay, number 5 is sales tax. So when you sell something, sales tax is often required by states to be charged. Hawaii is actually a little different, but I'll talk about that in a moment. The general way that sales tax works is you charge someone for something, whether service, product. So you collect their payment, and that includes primarily your revenue, but also a portion that's allocable to sales tax. And so you credit sales tax liability. And that's a liability account that then gets paid to the government. So when you pay the government, you debit the sales tax liability and you credit cash. Now, with Hawaii GET, we don't actually do this. You can pass on GET tax. Businesses can do that. They're not required to do that. Even if they do that, the amount just goes into revenue that you then calculate your GET tax on. And that's why, although Honolulu businesses pay 4.5%, you can pass on 4.71%, which accounts for GET tax on the tax that you pass on, which is why it's 4.71% instead of 4.5. Regardless, don't worry about it too much because it's actually a simpler calculation than passing on most sales tax liabilities. Okay, the last section, owner's equity. Just be aware that we have different types of capital accounts based on the structure of the business. Solopreneur, self-employed, single member LLC, they have capital contributions and a draw account. A corporation has stockholders' equity, shareholders. Multi-member LLCs or partnerships, they have a partner's account for capital and draw for each partner. And then the last group, number 6, this one isn't actually being covered by a group, is petty cash. And you can see these examples in the book as well. With petty cash, we're basically treating it like another bank account. So it's a current asset account. This entry is to create the petty cash account. You take the money out of a checking account and you debit petty cash. And petty cash is just cash that the business has on hand in an envelope or a safe so that they can easily buy small things. They keep those receipts and give those receipts to the bookkeeper. And that's what this next entry is, where you then debit the expense and credit the petty cash because it came out of the petty cash. There are other ways to handle it, but this is how it's going to be handled for the QuickBook entries that you'll be setting up in this chapter. And again, our petty cash would just be part of your bank balances right here. And then, of course, your expenses are part of your expenses. And so essentially, petty cash is just like another bank account. But because it's so small, it's not always even tracked that way like a bank account would be. Okay, that's it. So be sure to review in the forum. The forum labeled Chapter 7 video and interaction has the instructions and your groups, and then you'll be digging in and explaining one of these entries and just answering the questions about it. So you can review the section in the book and the entries I went over in this video to leave your comment, and then be sure to check back to review your group's comments, add your comment if you want, and then be sure to review the other groups as well, just to re-review these entries and practice explaining at least one of these in writing in the forum. All right, I will see you in the next video or office hours. Bye.